Moving your money from a local bank to a global tech giant could cost you $6,200 in annual income overnight. The new SGX-Nasdaq bridge looks like a shortcut to wealth, but for the Singaporean heartlander, the hidden toll is higher than you think. Today, we perform a forensic audit on the true cost of crossing that bridge. Most financial content is built around excitement. What is surging? What is breaking out? What you might be missing? I am deliberately building something different. Retirement-grade investing is not exciting. It is disciplined, forensic, and it is designed to still be working when you need it most. Under the skyscrapers of Shenton Way, a quiet tectonic shift is reaching its final alignment. The activation of this bridge in June 2026 is more than a back-office update. It is a corridor connecting Singaporean growth capital to deep institutional pools in the United States. Codified through the Securities and Futures Amendment Bill, this moves from a policy white paper to a live digital reality. The goal: bridge the liquidity gap between our local exchange and the massive depth of New York. For the heartland investor anchored to stable local banks and REIT distributions, this bridge offers a pathway to names like Apple and Nvidia. But that convenience introduces complex considerations that go far beyond having a local ticker symbol to click on. Buying Apple as easily as you buy DBS or Singtel sounds like an ideal scenario, but the Global Listing Board data reveals this may be a high-priced luxury for the unprepared. While the government has deployed nearly 4 billion Singapore dollars through the Equity Market Development Program to support liquidity, the forensic data tells a different story. Singapore dollar-denominated shares on the local exchange still face the risk of shallow order books compared to their primary counterparts in the United States. Even with that support, here is the insight. A bridge is only as good as the traffic it carries. If local traffic is thin, the toll you pay in bid-ask spreads will eventually consume the very capital gains you cross the bridge to find. The belief in the market right now is that a dual listing automatically gives you the same quality of execution you find on the Nasdaq. It does not. There is no market maker mandate here to guarantee narrow spreads for retail investors in the Singapore tranche. That is a structural gap no prospectus names, but every forensic audit must. We also need to talk about the mechanics. Unlike the initial public offerings heartland investors are used to, there is no ATM queue in Toa Payoh or Jurong for these listings. You must subscribe through designated retail brokerages. The framework mandates that 15% of the value, or 75 million Singapore dollars, be allocated to the Singapore tranche, but with a retail broker cap at $50 million, the dominant liquidity pool remains firmly in the US primary market. The cost of living impact shows up through foreign exchange drag. It acts as a hidden tax on heartland wealth. For an investor putting 20,000 Singapore dollars into these names through a multi-currency account, the spread markup often means an immediate loss of $150 before you even execute the trade. And if you trade in Singapore dollars to avoid that upfront friction, what you hold is a synthetic derivative. If the Singapore dollar strengthens by 5% against the US dollar, the local price of your shares drops by 5% even if the stock in New York has not moved at all. When we look at the yield verdict, the macro environment of 2026 makes the 4% risk-free benchmark of the CPF special account a very high hurdle. Apple, with a yield of 0.37%, and Nvidia at 0.02%, fail this hard gate catastrophically. For a heartland retiree, moving 100,000 Singapore dollars from DBS, which yields 6.22%, into Nvidia produces an immediate annual income loss of $6,200. That is the heartland paradox, owning the most innovative companies in the world while struggling to pay your monthly utility bills. Here is the second order effect most people miss. You might be holding a very liquid asset in a very illiquid container, and the cost of that container is far higher than any brokerage commission suggests. Without a market maker mandate as of May 2026, these global shares could effectively freeze during US market closures or periods of extreme stress. The underlying company may be a global giant. The structural liquidity risk is real regardless. Looking at our macro evidence dashboard, the nearly 4 billion Singapore dollars in bridge support acts as an institutional shock absorber. On the company side, Apple's second quarter revenue hit over $111 billion record growth. Nvidia is maintaining a net margin of over 55%, suggesting an infrastructure monopoly at a cycle peak. Meanwhile, the 6-month T-bill yield has stabilized at 1.46%. That remains well below our 3.2% forensic floor. The forensic anchor here is Apple's gross margin, 49.3%, maintained despite massive price increases in memory components like DRAM and NAND since 2025. That is pricing power in its most unambiguous form. For an investor in Philippines managing an SRS account, this margin is the wall that protects your equity value under supply chain stress. It means Apple can pass cost to consumers without eroding the share buyback programs that long-term investors rely on for growth. Our sector watch holds Apple in Zone 2 watchlist. That $100 billion buyback program is a genuine balance sheet sanctuary, even though it fails the yield gate. Nvidia sits in Zone 4 caution. Its agentic AI monopoly is real, but the price to free cash flow ratio is a structural flag at this valuation. Our local banking anchor, represented by DBS, remains supported. It passes all our hard gates with a 6.22% yield benchmark. The primary risk for 2026 is a peak in the AI demand cycle, resetting these valuations from above. If you want to see how I am stress testing my own portfolio against these liquidity traps in real time, join Iggy's Elite Investors. You will get zero-day access to my full spreadsheets and the precise foreign exchange drag calculators I use for the SGX-Nasdaq bridge. Forensic truth matters most when the market is moving fast. Let's look at the scenario matrix. In the bull case, sustained sovereign AI spending narrows these spreads and leads to a tech re-rating. The base case assumes stable support and moderate adoption with steady pricing. The bear case is a demand reset in the latest Blackwell chips, which could lead to a liquidity freeze in the Singapore tranche and a sharp flight to local banks. Every heartland investor needs to answer 3 stress test questions. First, can your retirement account survive a 5% currency drag if the Singapore dollar strengthens significantly against the US dollar? Second, does the diversification of the bridge outweigh that $6,200 annual income loss you accept when switching from a bank to Nvidia? Third, if you are using the CPF investment scheme, do you have the cash buffer to cover your obligations if local liquidity thins out during a US market correction? My 3.2% forensic floor remains my personal sanctuary threshold. It does not move for macro shocks. Apple shows high resilience, interest coverage ratio of 38.2 times. Nvidia is more vulnerable. At a price to free cash flow ratio over 50, it is highly sensitive to any cooling in the sovereign AI narrative, which currently accounts for over $30 billion of its business. If you are an accumulator in your 50s still drawing a salary, the bridge is a powerful tool to capture global growth without the friction of currency accounts. Monitor the forensic gap. Watch whether the price difference between the Nasdaq and Singapore narrows over the first 6 months. And even for high-growth assets, the 25% concentration rule remains your primary defense against a portfolio-wide reset. For drawdown investors in their late 50s or 60s living off distributions, approach this with extreme caution. The yield failure of these tech giants is a structural threat to your monthly cash flow, not a minor detail. Moving capital into these names is an income for growth trade. Unless your fortress assets like DBS or high-yield REITs are already generating a surplus above the 4.7% minimum hurdle, this bridge may simply be an expensive distraction from securing your retirement. The blunt question for an investor in Marine Parade is this: are you willing to accept a $6,200 annual pay cut in exchange for owning the world's most successful AI chip maker on a local exchange? Technology is a formidable engine for long-term wealth creation. But for the heartland retiree, income is the only sanctuary that pays the bills, and the bridge does not bring that. You are not here for the hype. You are here because you want the forensic truth before you commit a single dollar of your capital. That tells me something about the kind of investor you are. And here is the uncomfortable truth about how independent publishing works. The algorithm does not know you read every word or that you checked the gearing ratio twice. It only sees whether you have hit that subscribe button. Every forensic investor who reads without subscribing is invisible to the machine. If this analysis has helped you calculate a margin of safety, subscribe for free now and tell the algorithm that data-driven SGX analysis deserves a seat at the table. The true consequence of this bridge launch is the widening gap between the price of an asset and the cost of the liquidity required to exit during a storm. An investor in Ang Mo Kio might wake up to find local quotes are stagnant, burdened by a 1% bid-ask spread that did not exist when they bought in, even while US markets are soaring. This is the secondary listing trap that no prospectus will name, but every forensic audit must uncover it. We are entering an era where you can buy the world, but the world comes with a secondary listing premium. Will you be the investor who pays for the convenience of the bridge, or the one who ensures their retirement is not sacrificed for a digital shortcut? I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's Elite Investors get zero-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources, Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a men's licensed financial advisor before committing funds.